Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
Hey guys, so I'm sporting a hat today. I hope that's okay.
You enjoying this weather that we're having? Is this what you're trying to tell us?
This is actually my new bull market hat. So this is the hat I wear at the start of bull markets. Hopefully this is a sign of a better market environment for lots of stocks. So we'll see. This is actually the green light hat from Matthew McConaughey's book, Green Lights. So this is I bought the merch after I bought the book.
Gotta
You've been wearing it for like 3 days. You help small cap value a lot. So you got to keep it on then.
Exactly. That's what I'm going for here. So we're going to talk about something different than stocks today. We're going to talk about a subject that, I know not much about. Jack, you know a little bit about, and Matt, I think you know a lot more about, and that's the topic of annuities. And we're going to talk about what an annuity is, the different types of annuities, maybe where an annuity can work for an investor. I think some of the maybe downsides of annuities are the things that you would want to consider if you're considering investing in annuities. And then, at some point, I'm interested in your feedback. I'll give you guys sort of a personal story of something a decision that I had to make. It's not necessarily an annuity, but I think of it like it could have been an annuity for my wife and I, and I'll share that with you maybe at some point as we get into this. But Matt and Jack, maybe let's just start out by let's talk through what an annuity actually is.
So let's go way back in time. I do have a great pop culture reference, I think, on this one, by which I mean borderline tasteless, but entertaining. So if we go way back in time, you'd give money usually to the king. And the way that it would work is I would say, and I'm going to use modern dollars just for an example. I'd say, hey, king, I've got $100,000 or, $100,000 worth of chickens or whatever it is, your arrangement. You give that to the king, and now the king basically gives you a king's pension. So an annuity is like an annual installment plan. So I give the king $100,000. Now the king gives me $10,000 back plus a little bit of interest for the next 10 years. And that's the arrangement. The idea being in a pre-banking era, one way to think about this, it was a way to take, if you had a windfall or something that you had, put it with the king, the crown, somewhere safe, and then get a piece of it back over some period of time. So a really effective saving and investment vehicle when there were no savings or investment vehicles. You play that forward and into the Renaissance, and now just not the kings are in the game, but now wealthy people are in the game. So now you have wealthy families, stuff like that. And this is where annuities and sort of the modern annuity is born, because you have more complicated arrangements. I'm going to give you this money. Are you going to start to pay me out today? Are you going to wait a year? Are you going to wait longer? Is this tied to the cost of shipping something overseas? You get these variable pieces of the policies that enter into history. Shortest, simplest form though, you're giving a pot of money to somebody else, and they're giving you your money plus a little extra back in return. And if it's okay, can I make a pop culture reference to this?
Yeah, we'd be upset if you didn't.
Okay, I was hoping that would be the answer. Are you familiar with the poet-philosopher Rick James and his body of work?
Oh, absolutely.
Okay. Do you know the classic Give It To Me, Baby?
Yes, I do know that one.
Okay. I won't say you should go watch the video if you don't know the song, but I will also say you should go watch the video with, the dated glasses and maybe watch the Chappelle skit just so you get the whole gist.
I love that Chappelle skit. I can watch it over and over again.
We'll do that too. So the premise of the song is we find our protagonist in a committed relationship with this woman, and they're going to go out, they're going to do the things, you know, they're going out dancing, and then she's tired, but Rick is just getting started. And this, I think, this is annuities in a nutshell. You have something great, you have this pile of money. Now you enter into a committed relationship with said money and an insurance company on the other side. But when you want to go out and do things that are different from the rules of this committed relationship that you're now in with this company, stuff gets a little bit messy. Annuities are great if you're going to play by the rules of the relationship. If you want to go be Rick James about it, you might get yourself into some trouble.
So I hate to spring this on you on a live podcast, but next week I'm going to be hosting a steak dinner down at the Ruth's Chris by the retirement community. And, I might have some annuity products to offer. So I was wondering if you might be around to attend that.
I am definitely available to attend. Unfortunately, my grandfather can't attend, though.
Yeah.
He was my plus one. He doesn't do the Ruth Chris. He's more of an Applebee's guy.
But how much of that, that's people like me outside the annuities industry think about that and think that's like the reality. And it might be like, how much of that is true in terms of that's the way annuities are sold, and it's guys in suits taking huge fees from people. And, although they're paying for the steak dinner, you're going to pay them 100x that over the rest of your life. Like, how much of that is true about the annuity industry in general?
So I hate to say this, but it's 100% true, but it's 100% true in the same way that, like, you don't go onto a used car lot without some idea of what you're doing. You don't enter into these engagements without some awareness of, like, you're being sold. And anytime you're being sold, there's some incentive structure that may or may not be stacked against you. And the better you can understand the incentive structure, the better you can understand how to not get screwed. The steak dinner thing is real. I would liken it to like timeshares, which, have you ever been to any of these dinners? Either an annuity dinner or a timeshare dinner or anything in between?
I have not. I thought about going to one just to see what happens there. I've never done it.
My wife and I were in Key West at one point, and this goes years back, and maybe it was Disney. Anyways, it was like we got roped into, come look at this, and we got walked up into this room, and there was like all these desks, and there was all these conversations. Like there was probably like 40 different like salespeople trying to sell people on timeshares, and it was very weird, and I felt like it was fake. I was like, we're not interested. We just wanted the free dinner or whatever,
It feels like a bad episode of like The Office or something, right?
Yeah, for sure.
So it's real, and I guess this is I want to just bring this up. There's a commission structure in these things that's inherent, and it's mostly inherent under, a lot of people may not know that advisors, there's kind of two different places they can be. I'm grossly oversimplify this, but you can either be a full fiduciary, or you can be affiliated with, which is usually like a registered investment advisor is going to be full fiduciary. That means they're more or less legally obligated to put your best interest first, which means they have to take your whole situation into consideration, and they're swearing by that oath, if you will. The other side is the broker-dealer side. And on the broker-dealer side, you have people who they're dealing with an inventory, or they might only represent one company that sells one type of annuity or insurance product or whatever else. And they're incentivized by commissions to do what they're doing. They are required to do something that's in your best interest, but it's a little bit different. And what I believe you generally see is you see more douchebaggery on the broker-dealer side than you do on the RIA side, but there are duly registered people. I used to be duly registered till I dropped the broker-dealer side. There are people who, when given a way to earn a commission, will do terrible things. And a good rule of thumb is if they're buying you and a group of 50 of your closest almost friends dinner at a steakhouse, just probably run.
There's, in mutual fund prospectuses, there's always required to be a chart that shows like what the cost of that fund is over, whether it's 1 year, 5 years, 10 years. I believe they have it over 10 years, over different time frames. And I think like that would be probably pretty valuable with annuities, right? To like actually say, okay, maybe it works for me, but what is the total cost of ownership? And seeing that in black and white, because if that is some like crazy number, then it's like it's probably not. The fees are crazy, and we're going to talk about the fees. I guess maybe I'm jumping ahead a little bit, but like that would be, and I'm sure that's somewhere in the fine print, but you should be asking that, I think, for sure.
You should be asking, and I'm sure we'll drill more into this, but this is a tool that can be used really well and it can be really effective. And there are circumstances where these are great and they might be expensive, but it can be expensive and still be good. So they can be misused. And the unfortunate reality is because they can be expensive, there's probably more ways for them to be misused. But there's lots of good ways they can be used too. And that comes with a cost, but just like a nice car has a higher cost to it to service and whatever else, it's making your life better. It's making your life better.
On the issue of them being good or being misused, like how often when you have a new client who comes on board who has like an existing annuity, how often do you look at that annuity and you're like, yeah, that was a really sensible thing for them to do? And how often do you look at it and you're like, this is a bunch of garbage that someone sold them? I mean, how, like, that's probably a good barometer of like what's going on out there in general. Like how often does either one of those happen?
So this is like the unscientific answer, but candidly, I would say it's got to be 80 or 90% of the time you got sold something, because it just makes no context. Like we put the plan together and it's like there's no context for why this makes sense. The only context is somebody settled on an arbitrary round number and convinced you to do it to put some money in their pocket. And that's a pretty crappy feeling. And I hate having to point that out to people, but it's very rare that I see something that makes sense. In the cases where it does, it's usually because it makes sense because there was a specific like risk or income need. And frequently in those cases too, it might be something that made sense. Sometimes it's something that made sense 20 years ago because of something that was happening. And then it's a question of does it still make sense today? Things like that.
You alluded to this a little bit before, but I want to talk a little bit about the different types of annuities. I know there's like immediate and deferred annuities. There's fixed, variable, and indexed annuities. Like, can you just talk about like the major types that exist? And then maybe also which ones are actually used the most in the real world? Okay,
so an immediate annuity, and this is really good because people say annuities, but there's all these subcategories and it's important to go through them. So an immediate annuity just means, back to I give the money to the king. I give the money to the king and they're going to immediately start paying me back. Now, really important concept for this. I'm going to say this word and then I want you guys to explain it because this isn't normal human speak. So amortization table, which we usually think about with like loans and mortgages. When you guys hear amortizing, like what comes to mind?
Yeah, just paying the interest over time, like in the principal over time. I don't know. That's maybe too simplistic.
For me, it's like, what is your payments and then what is the balance of something over time? That's the way I kind of think of it.
So you're both spot on. And it's just saying like you're getting payments and there's a breakdown of the internals of those payments. So when we say annuity and when we talk about annuitization is the act of getting money back from one of these policies or getting money out of one of these policies. In an immediate annuity, we're actually taking the money that you put up front and then usually some form of interest. So just like if you had put your money in like a treasury bill or a treasury bond for the next 10 years, you'd be getting like interest back and then principal at the end. When we annuitize a policy or do an immediate annuity, what we're doing is we're getting our own money back. So we're getting principal back and then we're also getting interest. So some imputed interest earnings on that money too. And we can break that out in an amortization table that basically is going to say, I'm getting, like if I put the $100,000 in and I'm getting $10,000 back a year for 10 years, I might actually be getting $10,500 back. And 10,000 is going to be my return of principal. The 500 is going to be the calculated interest, and it may or may not change or shift over time. So immediate annuity, I put the money up, I immediately get money back, and there's a breakdown of those two things. Pausing for a second. Did that make sense?
Yes. Yeah, definitely.
Yeah, totally.
Okay. Also important, just to say it out loud, because we're going to keep coming back to this, that interest, it's in the name, but how do you think that's taxed?
Is it just as like income or no?
Ordinary income. Now, why is that important? Because like, think about this. It's not a dividend because how are dividends usually taxed?
Yeah, at a more favorable rates.
More favorable rate. So whatever you're doing on this, the interest component is coming back to you at the ordinary income level. Another reason why when we see a lot of these things, we're like, did anybody do any math about this? Because you're creating an income tax liability at your highest rate. So that's important. Okay, so immediate, I put it in, I'm getting money back usually pretty much right away. Deferred basically refers to any annuity, contract, or policy that the money doesn't start coming back right away. It might be I'm waiting a year, it might be I'm waiting a longer amount of time in different types of policies. Critical to understand, I'll get into this with the next couple of types in a second, is that word annuitization. I can have an annuity, frequently a deferred annuity, where I could have the annuity for 30 years before it enters annuitization and starts to return via annuitization my original money to me. This is where it gets a little squirrely, but now let's go into, so you have immediate deferred. Once we get in deferred, we get into this whole other category. And this is where we find our fixed annuities. We find our indexed annuities, or index annuities sometimes, and we find our variable annuities. Do you guys have any experience with any of these three, really? Or you've heard about them, I'm sure?
My experience is passing the CFP exam, so having to learn what they all are, but we've never actually used them in the real world.
Yeah, but I think I don't know. Like I said, I don't know a lot about these, but I think I can kind of get a gist based on those labels what the annuity actually is delivering.
Let's play name that annuity. So if a fixed annuity, this should be pretty self-explanatory. What would a fixed annuity resemble or be like?
I think it would be like a fixed payment, at some point in the future, probably.
Okay, that's pretty good. And I want to classify this again. The immediate annuity starts the payment right away, and you kind of know what you're getting right from the get-go. When we're talking about deferred, we're talking now about a deferred fixed annuity. And what a deferred fixed annuity basically does is, to your point, it's a fixed payment. It's in the name. It can be a lot like a CD, or a treasury, or pick a bond, with the idea that I might put up my $100,000. It's deferred. So my $100,000, let's say it's a 5-year fixed annuity. $100,000, the insurance company says they're going to pay me whatever the interest rate is. And then at the end of the policy, I'm going to get my principal back. If I want it, I can walk away. But for that period of time, I'm going to get whatever interest they're paying on it. There's an important detail here. One thing that makes the fixed annuity different from going out and buying a CD or a bond is what you can do with that interest. Annuities have this feature, and this is why they have their own section of the tax code. They have this feature that allows the annuity to not distribute those earnings. So I can get a deferred fixed annuity, and I can basically say that, let's say it's paying 5%. And I can say over the next 5 years on my $100,000, I'm basically going to get my $5,000 a year. And I don't have to pay taxes on that $5,000 that year. So at the end of the policy, my policy is now worth $525,000 in this scenario, and I haven't had to pay any tax. So deferred in the start date of the annuitization, but also deferred in that tax liability. Did you follow that? We're going to keep checking in on this one because these details get squirrely.
Yeah, no, that made a lot of sense.
Okay. Now, what do you think the problem is with deferring that income tax liability?
Well, you have a big tax bill at the end of the period, basically.
You cash this bad boy out. Well, now instead of having $5,000 a year in ordinary income, you have $25,000 in ordinary income all in one shot. Not the most tax efficient vehicle from that standpoint if you don't know what you're doing or you don't know what you got sold. Make sense?
Yeah.
Yeah.
Okay. The next one we'll cover is, because it's a little bit of a hybrid, it's called an index annuity or indexed annuity. And the index annuities basically say it's like a fixed annuity, but instead of a fixed interest rate, what they offer is they usually offer a benchmark or something you can get the returns off of. So we're going to do the ultra simple version of this, but one reason people will like them and one reason they get sold is these things don't have any downside. So I put the $100,000 in, then the index annuity might say, with your $100,000 in, we'll give you exposure to the S&P 500. And the insurance company goes out and they buy options or futures or whatever combination. And they basically say, if the S&P 500 does more than say like 4%, you're going to get the 4%. If it goes all the way up to 10%, we'll give you the whole 10% in a given year. We'll credit it to your account. However, if it goes over a usual amount, usually they have to set like an upside limit on how much they can pay. So if the index goes up 30%, you might get capped out at 10%. So the allure of and it's literally called like a fixed index annuity. The allure of the deferred fixed index option is that you can basically get more upside potentially with less downside, although that upside is almost always capped. So this is a lot like some of those exchange traded notes and other things that I think you guys have talked a little bit about in the past.
Yeah, the buffer, or like buffer ETFs, yeah.
Totally. And it's the same set of math. Again, I just want to point out though, whatever those gains are, whatever that is, and we'll talk about variable in a second, like it's not a gain from an investment. Whatever the earnings are, however they're being held in that policy, it's ordinary income when it comes out of that policy. Super important. Okay, so the last one, or the last major one, I should say, is the variable annuity. Variable annuities, I personally think are the most confusing for people to understand. They're nowhere near as popular as they were 10 plus years ago. I used to see this a lot early in my career, and especially pre-financial crisis and right after. But basically what you have is you put your money up, and then instead of having like a capped on your downside and a cap on your upside, they'll usually promise you, we're going to credit your account 6% a year, fictitiously on paper here. But if your account grows by 30%, your account grows by 30%. And so what the variable annuity is it gives you a menu of investment options. It can do better, it can do worse. And there's a calculation for at the end how you might start to take money out of these policies. They used to be sold with, and they still are, I'm sure, with this idea of we're going to promise you, say, 6% a year. And when you want to take the money out sometime later in life for retirement or whatever, we can turn this into like a pension. We'll give you 5% of the value a year. And if you do better than our promises, you'll get more. If your investments do worse than our promises, we can forecast approximately what that would be when you take the money out. Great way to use those things, terrible way to use those things. Most people, it just didn't really make that much sense if you're willing to do the math about it.
Of all these types, which ones end up getting used the most in the real world?
Used or misused?
Or yeah, well, I guess you could answer both separately.
So we see all three kinds or all four kinds pretty regularly. I think the kinds that are the most useful and the planning community, the ones that you see used most by the actual planning community, are the immediate annuities, also generally referred to as SPIAs or single premium immediate annuities, if you hear that language anywhere. And that's because we know, so goals-based planning, if we're talking about someone having a specific consumption goal, and this could be anything from I know roughly what my basic household bills and expenses are, to I know what the premiums are for this life insurance policy that I got to pay for the next 20 years to pay the tax liability of my estate. Whatever the scenario, the easiest, most reliable math, especially for consumption, can be solved with a single premium immediate annuity. Another perk of those, and the reason why the planning community tends to use these the most, is you can do them with, they're called period certain. So I can say I want to set this up for the next 10 years, or I can also set it up for maybe like the next 10 years plus life. So I might say $100,000 in, 10-year period certain. I'm basically going to get all my principal back over that. But if I live beyond that point, the insurance company now is going to keep writing me checks, and there's ways to structure it. The other side of this that I just want to say on the single premium immediate annuities, in many scenarios, the risk you're running is you put up your $100,000, and I'm curious if you guys have ever heard of this. I put up $100,000. It's in a single premium immediate annuity. I get my first $10,000 in year one, but then year two, I'm dead. You ever heard of this scenario? Do you know what happens?
I don't know.
Well, guess where the remaining $90,000 goes in most of these scenarios?
I don't want to assume the worst here, but
Go ahead and assume the worst.
Does it like go back to whoever issued the annuity?
Okay, that you officially came up with a darker scenario.
Yeah, I was like, that's even worse. That's really bad.
The guy who brought you in for the steak dinner is like, oh, hey, 90,000
Yeah.
bucks.
What does it go
that's
like?
too.
Is it like it doesn't? You can't name a beneficiary on it or something, so it goes into like the estate, which then goes into probate, so it makes it like complicated. Is that?
So that can happen, but the main scenario that people tend to not like for good reason is if I do a single premium immediate annuity with no, some of them now have death benefit options. I'll touch on that in a second, because sometimes you want it, sometimes you don't. That money just goes to the insurance company. The actuaries win. They were basically saying you didn't make it for this period of time, so therefore you paid this premium. It all just gets absorbed into the insurance company.
Yeah, that's
Have
what
you
I was.
ever heard of this?
I guess I used the wrong word, but that's kind of my idea. Is they just get it back. So yeah, basically they're using like these mortality tables, and you're making a bet effectively. Like if you live a really long time, you win. If you live a really short time, they win. If like the average happens, kind of, then you get the average scenario. That's basically what's going on.
Perfect. And it's also perfect that you put it that way, because so number one, this is why a king would want to do this, thousands of years ago or hundreds and hundreds of years ago, because it's a way to basically take the actuarial risk of the population and spread that out. And that way, if somebody lives really long, they're not poor and destitute. But if somebody dies early, it helps offset the risk for the rest of the risk pool. It's an insurance vehicle. This is what it's supposed to do. There's two scenarios that are worth mentioning here too. You might have in a single premium immediate annuity, a scenario where you have a spousal beneficiary, someone else. So people will sometimes, a husband and a wife can buy one effectively together and can insure longevity risk on both lifetimes. That's a really big win. Or another scenario, which is actually kind of funny. You guys are in Connecticut. One of the guys who took this, I believe, all the way up to the Supreme Court, is of all places in like Wethersfield, Connecticut. And for Medicaid, which we should probably do like a Medicare, Medicaid episode at some point, because it's other things that touch just about everybody, but few people know about. For Medicaid, you've heard of this thing where you have to like spend down your assets. You've heard of this?
Yes.
Yeah.
An immediate annuity can be really effective, because what better way to spend down your assets than to basically give them all to an insurance company? Because now they're out of your name. You no longer have the assets. And in turn, the insurance company can turn back around and make a payment to you. So in some rare, and this is definitely one of those things that you want a qualified person to do the math with you and an attorney to do the legal side of this as well to make sure you're protected. But some companies have these Medicaid safe annuities, and another way you can use these really well. You have a husband and a wife getting on in years, and you know that because of, so I've seen this firsthand and I've done this for clients in my prior career. You got two people, they're in their, let's say in their 70s, or maybe they're 80 years old. So they're not going back to work. Like that's a definitive, nobody is going to go get a job. Now something happens with one spouse, and it's clear that the care for that one spouse is going to exhaust their assets and result in the surviving spouse basically being in a really crappy situation for money. A single premium immediate annuity can basically get the spouse who needs the care, can help fast track them to get entitled for Medicaid so they can get state care. And we can preserve an amount of income in the form of a pension in the single premium immediate annuity for the surviving spouse for after. Very rare circumstances where this tool can be used or make sense, but it's kind of a perfect use case.
So going back to that mortality table issue, like let's say, just as an example, let's say I'm Justin, I'm going to be 70 years old. I'm probably going to still be running 5-minute miles at that point. Like I think I'm going to live like a lot longer than everybody else. Like, is that a good use of one of these types of things? Is like, if I think I'm the healthy guy that's going to live like a really long time, I'm taking advantage of the people that aren't by buying one of these. I mean, is that a good use of these types of things?
That can be a great use of these things. And back to the whole cost thing. Like if you know that you have longevity risk, you need to plan for longer, number one. But number two, then the policy might be more expensive on a bunch of objective measurements versus other vehicles. But the policy might enable you to insure against your own longevity concern. And if that's the case where you're using this to insure against longevity returns, we don't sit around and talk about, aside from in Progressive and Geico commercials, what the cost of car insurance is. But we all know the benefits if somebody gets into an accident or a fender bender or whatever else of like having that insurance, the benefit get paid. And so in your scenario, if Justin thinks he could live to, what's the Ricky Bobby quote from Talladega Nights, like modern medical medicine and science, I could live to 300 years old. Shift that risk to the insurance company all day long if that's your case and pay for it.
So we had Wade Pfau on the podcast, and I know he's someone who does advocate annuities, and he's a good example of someone using them in the correct way. Like those types of guys that are using annuities like that, I mean, are they typically using these single premium deferred annuities? Is that what they're doing? Or single premium immediate annuities?
That's in the planning community. The most often use case is going to be in something like that. The reason you haven't heard as much about this in the last 10 years is because with interest rates effectively at zero, you might as well throw the thing in like a savings account and take it out yourself. Now that we're into the situation of interest rates aren't zero anymore, I think you're going to see an uptick in people talking about single premium immediate annuities because you can both hedge longevity risk as well as get your money back plus interest in a guaranteed fashion. And that's really attractive if you know your specific consumption goals, which a real financial planner is going to work through with you. Somebody who's just an investment advisor probably isn't going to map out those consumption or gift goals and think about what the tax ramifications at each stage in the puzzle are.
When I was researching annuities, I came across this term surrender periods. Can you talk a little bit about what that is?
So a surrender period generically, and you'll see this anytime you're being sold an annuity, largely from someone who works for a broker dealer, and it's a commissionable product. And the idea of the surrender period is when you put the money in, you pay the initial premium deposit, whatever it's going to be. The broker, the person who's selling you this, gets their commission. And the insurance companies are really generous. Sometimes they take that out of your money that you deposited, but the broker's getting cut their check. And a surrender period almost always is going to refer to if you decide that you need the money back. So let's just say you have a policy and it's got a 5-year surrender period. What they're going to say is, we paid this broker upfront this commission. And if you decide you want to leave Mr. and Mrs. Client in year 1 through 5, we have a descending scale to make sure that money we paid out to the broker, we're going to claw that back from you. If you have an annuity, find out what the surrender schedule is, and just know if you have to break terms early, this is extra money they're going to come pick out of your pocket before they let you take it.
And I just want to dig in a little bit more on the fees thing. So is it fair to say like a lot of the fees charged for annuities are upfront fees? I mean, I would think part of it is there's also like indirect fees in terms of the insurance company's earning a better return on my money than they're paying me. So effectively they're earning fees that way as well. But can you summarize like the total ways people get charged fees on these things?
Yeah. There's upfront fees. There's ongoing management fees, often referred to as M&E or other fees. If you look inside of any variable annuity statements, can be brutal like this. You could pay 5% upfront and then be paying 2.5% a year with a bunch of riders. And then you might even have a surrender charge on the back end for 5, 7, or some other period of time. Index annuities too. You got to look at this stuff and know what they are. So you have upfront fees, you have ongoing fees, and then sometimes you have back end fees as well. They're kind of brutal like that. There's a wrinkle to this that's specific to annuities that you should also know, which is you can also take basically 10% away from a policy. It'll reduce your benefits, but you can take 10% away from a policy pretty generally across the board. I can't remember I think there's actually a law that says you can do this, so they all have to allow it. So I can take 10% out of a policy, usually penalty free, but do the math on that. Like I can get all my money out in 10 years. So if I have a 10-year surrender schedule, which is pretty extreme, I can still take my money back out, but I have to piecemeal it out to not get hammered by the surrender charges or penalties. Unfortunately, those 10% penalty-free distributions, I've helped more clients do those and unwind annuities over long periods of time than I care to admit.
You talked about how a lot of the annuities that come to you aren't the greatest annuities, but I'm also wondering like the side of you being involved in them. Like, are you thinking it's a good idea for a client? Like, how often do you look at a client situation and say, yeah, an annuity actually makes a lot of sense for this client? I mean, does that happen often, or is it sort of a rare thing?
It's a rare thing, but I'll give you at least 2 examples where stuff works out. Had an example years ago where we had clients where husband was older and got sick and cancer, knew it was terminal, and there was a situation where they were able to structure, this is before I worked with this client, but again, something I took over where I was like, this was smart. This was actually smart. And what they did is they structured the annuities in the terminal husband's case. This is pre-financial crisis. The annuities had some really generous death benefits that would carry on to his wife. So it basically saved her from the financial crisis because she didn't participate in any of the downside, got a juiced up death benefit, and then inherited a bunch of stuff that ended up producing an income stream for her that lasted well into retirement, will last her whole lifetime. And so that was a case where it was like they used the spousal relationship, they used the income need, and they solved for all the right things. And this was sold by a broker dealer, by the way. So they can be done in a way that's good. Now, a way that it was done not so well, but where an annuity was the solution to the problem is, so there's that whole tax deferral piece of like compounding the income. So one thing that happens sometimes is you'll have a parent who will get a fixed annuity or an indexed annuity or a variable annuity, and they'll basically just be letting it grow. So parent gets sold the $100,000 policy, 30 years goes by. Now the $100,000 policy is worth $500,000. So now the parent has a $500,000 policy with a $100,000 basis, and the parent dies. And let's just say there's one kid in this scenario. So if one of you, if your parent had made this decision and your parent dies and they have something that's worth $500,000, what's your gut say for what you know about how this stuff passes and what tax you might owe?
So this is a parent, and would it pass down to the child?
Let's make this comparison. If somebody had they die, you find out they have $500,000 in a stock, McDonald's or Apple or something.
Well, that's going to certainly pass down, right?
Okay. What happens on death for most assets, a house, a stock, whatever else? Do you know the rule?
The basis gets stepped up.
Exactly.
Okay. In an annuity, the basis does not get stepped up. This is one of the biggest, I'm going to say, flaws that people don't necessarily understand in full. So if mom buys the annuity at $100,000 and it grows to $500,000 because she's just let the income just roll up and defer, now son inherits the money. It's a $500,000 contract. It's got an embedded $400,000, not a capital gain.
Oh, wow.
$400,000 of ordinary income.
Yeah, that's
no step up.
That's not ideally
That's
what you want to see.
Not good. These are blanket statement, kind of horrible, like estate planning tools because of this. You get all the disadvantages in this case. You should not be using an annuity to like pass on wealth to future generations. Somebody can tell me the one scenario where it makes sense, but this is a mistake. So something that parent could have done before they died is they could have figured out a way to, like, they could have taken the income for themselves, because if they're 90 something years old when they have this policy at the end, like, take the income, you'll pay less on taxes, maybe take it out over 3 or 5 or 10 years. Or there was ways the parent could have structured it. But in my case, we didn't exactly know what the parent had until they died. But now we're staring at this situation where we have this giant embedded tax liability. And this is a case where sometimes the two wrongs don't make a right. There are annuities where you can do, so there's this thing called a 1035 exchange. Do you remember this from your CFP stuff?
Yes, yeah, I do remember that.
Okay, do you remember what a 1035 exchange is?
Not exactly, but I know it's tax-free.
There you go. So in this case, a 1035 exchange allows you to go from one policy to another. Back to the sales and the commission thing, this is how somebody could sell you one bad annuity, turn around and then sell you another second bad annuity on the heels of it via this thing called a 1035 exchange. It's a tax-free transfer between policies. So in the case with the mom passing this on to the son, what we did was we did a 1035 exchange of the death benefit. So of the $500,000, of which $100,000 was basis, $400,000 was deferred investment income. And what we did is we converted it into a form of a single premium immediate annuity that would basically take that $100,000 in the interest and combine it in that amortization table and pay it out over a much longer period of time. So instead of getting shellacked with $400,000 up front and all at once, we were basically able to say, we weren't expecting this money and we don't technically need this money. Client's relatively young. Just give me a check once a year for the next, in this case, like 30 years, and mix in the principal and interest so I don't get destroyed on income tax every single year, forever.
Yeah, with some of these complications kind of get at the last thing I wanted to ask, which is, this seems something that's very difficult. Like your average investor has to be very careful about using these things because not just of their fees and other things, but there's a lot of other behind the scenes things, estate planning and taxes and other things that come in here that people probably don't even think about, like when they do this. So I'm just wondering at a high level, like other than avoiding the steak dinners in general, like what are some things someone who's not using a plan or someone who's looking at annuities, they might want to keep in mind when they look at these types of things?
So the things that they want to keep in mind are stay away from the steak dinners. Make sure you understand, just like any investment, you should understand like where you are before without having the investment, how when you acquire the investment, what the costs and ongoing services and whatever else are that are associated with these things, and then how it gets unwound on the back end. And generally speaking, if somebody's doing like full-fledged financial planning with you, they're walking through all these things and they're saying, this is why this is a fit. This is why, unfortunately, we see people who are, out there, the man with the hammer, every problem looks like a nail. And in this case, it's like, well, I've got a screwdriver and I'm trying to bang this nail in with it. And it makes no friggin' sense. But if you take the time to actually understand, where am I before this thing? How does this product work for me? What does it cost me upfront, ongoing on the back end? And how is it unwound on the back end? And why is that to my benefit? If somebody can walk you through all those steps, then an annuity might be right for you in your situation. In the event that they can't, or that they don't, or these conversations aren't being had, then go the other direction. And I want to say this too, because this does happen with people's parents, especially aging parents, because the sales practices can be aggressive. If you find out, and I had this happen, this is as close to a real story without disclosing details. I had a client call me and they were like, I just got to my parents' house and, my parents were, in this case, they had not dementia, but just they were getting on in years and weren't exactly clear on stuff. And they had just bought this annuity. And the daughter in this case was like, what? I don't understand, but apparently they just bought a several $100,000 annuity. And like, I don't know what's going on. What do I do with this? Turned out the guy who sold her this annuity had driven like 3 hours to sell this policy off of a cold call. And so we went on to go to FINRA broker check, look these people up. I find this guy. This guy had like defaulted on like 3 trailers in Florida in the last 5 years, multiple bankruptcies, and he's driving 3 hours to sell a several $100,000 insurance policy and via an annuity to these like people who like clearly should not be making these decisions. Because she called me, we were able to cancel the policy. There's a grace period on this stuff. And we saved like the parents from a pretty ugly situation just because somebody said something felt wrong. And I just want to stress that too. They're not for everybody. And if you see somebody else getting involved in one or that seems to have incomplete information, get a professional who can untangle the whole mess for you and isn't incentivized to keep the shroud of mystery around it and take money off of it.
Yeah, and just to share sort of a personal story with you, and it's not specifically about annuities, but the payments would have been like an annuity. So maybe like 6 or 7 years ago, my wife, who was a state employee, but she's in the healthcare profession, her union negotiated with the state and they opened up the pension plan to allow, so they weren't in a pension plan at that point. The previous state workers were in her union, but there's different tiers of state workers. And so they basically like said, you can buy in to the pension plan with a certain amount of your 401k or 403b money.
Buy in with like credits, right? Like,
yeah. Well, it was, you actually would have had to transfer assets out of the 401k over to the state pension plan. And, there was a number of good information sessions, and I know a lot of people consider doing it, and I think especially for the people that had been at the state much longer. She had worked there like 12 to 13 years at that point, something like that. So she wasn't like a new employee, but she was kind of in the middle. It wasn't like a 25-year state employee, which I think that's when the benefits got really attractive. But anyway, so I sort of thought about this. It would have been a portion of her 401k. We would have had to transfer that over to the state. But at the time, I was a little bit concerned about just the state's financial well-being to some extent. And also, like, when you do that, you're sort of like the money's coming out of your account and you don't have control of it, obviously, anymore. You're in a pension plan. So, we decided to pass on that. And I don't know, in retrospect, I kind of, in thinking about it now, I sort of wish maybe we hadn't done that. I think in thinking about our assets in retirement, I think if we would have had this, asset pool of like stocks and bonds and things that are going to obviously go up and down with the market, and you're going to be drawing off that, but then we would have had Social Security, and we would have had, this income stream from the state pension plan. It would have further diversified the income in retirement, which I think is always a good thing when you can sort of do that. So anyways, that's just my sort of personal story of a decision I made and the way I thought about it. The other thing, Matt, that you brought up, and I thought was a good point, I've always thought like these assets, if my wife and I don't exhaust them in retirement, they will go to my girls. So in the case of the pension, we would have put that money there. It would have been the pension. We would have got the income stream, but then eventually, when we're not around anymore, that, they're not going to be beneficiaries of that money. So that was another sort of thing that I sort of thought about in making that decision. But anyways, just sort of in concluding with a personal story. I don't know if you guys have anything to say to that or not, but
Thought about the front end, you thought about the middle, you thought about the long term. And that's the key. And I think that's the theme of all these conversations that we're having with this Education of a Financial Planner series. You had to actually map the whole thing out and think all the way through it. And that's not easy. That's complicated. There's a lot of steps. But everything has its upsides and its downsides. The pension system is a form of an annuity, and it's a mechanism for basically pooling the risk of longevity across a population of people. And that has real advantages. Same with Social Security, same with, same with your car insurance. So there's not one size fits all. Everybody's got a slightly different risk profile, just like everybody's got their own inflation rate. And you figure out what's right by you and your family. And then if it's an annuity, great. You found at least the answer that works for you and your family. And if it's not, make stake at home.
So this has been great. Thanks, Matt, for sharing your sort of wisdom and expertise. We know this is kind of a complicated topic, but hopefully we've done a good job of giving a nice balanced sort of, approach or opinion on the pluses and minuses of annuities. So thank you guys very much for watching. We'll see you next time. Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at @JJCarbono and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.